All right, it's finally here, the moment we've all been waiting for. NVIDIA earnings coming up after the bell, after a rocky couple of days. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is on assignment today, and Bloomberg Open Interest starts right now.
All right, coming up, after 4 days of declines, stocks face a critical earnings test. Will NVIDIA reclaim its aura of invincibility? Meanwhile, over in Washington, the House advances Trump's tax cut plan while the president doubles down on auto tariffs. And speaking of autos, they're on the move today, from GM's new buybacks to a disappointing forecast from Stellantis. All of that and more coming up. Let's take a look at where markets are trading. Like I said, 30 minutes until the bells officially ring. You can see we're trying to build a bid in the pre-market right now, trying to rebound from that 4-day losing streak on the S&P 500, on the NASDAQ 100 as well. Currently a little bit higher pre-market, but we know that all of the action today is going to be after the bell. But nonetheless, a little bit of a bid right now. Can't say the same for the bond market. Actually, yields are a little bit higher to start the morning, but now you can see we're just about unchanged. The bond market has really seen that haven bid materialize in the last week or so, bringing yields all the way down to under 4.3% on the 10-year Treasury yield. Somewhere, Scott Besson is smiling right now.
Yeah, we've been talking about that. The reason, though, is killing me, but the level has been holding. Let's take a look at some things before the market opens. Of course, NVIDIA leading Magnificent Seven stocks higher this morning. Today is its first earnings since the threat of China's DeepSeek sent the stock tumbling in January. Shares are expected to move about 10% in either direction following results, and other big tech stocks bouncing back today, including Palantir and Tesla. And Katie, it is just remarkable here because NVIDIA is off significantly since its highs in January. Tesla has almost lost all of its gains since the November election, yet you do have Mag 7 in correction territory. Let's hope NVIDIA can save the day.
Absolutely. All eyes on Jensen Huang and the poetry in the Bloomberg News headline today. NVIDIA's shaken aura of invincibility is set for an earnings test. And I really think that that captures the mood music, Sonali, though. I will point out that we're going into this round of NVIDIA earnings with much more realistic expectations. You mentioned that the stock is down sharply from its January peak. And also, Bloomberg News pointed out that NVIDIA shares are actually lower since they last reported earnings. We haven't seen that dynamic since 2022.
That's fascinating. How far are we off since the January high? More than 15%. It's nothing to sneeze at here, but there was a lot of promising news heading into today that includes, as you pointed out in our morning meeting, that news from the information that Meta might put another $200 billion to work to build out data center infrastructure. The question in that story was over what timeline.
Right.
And that's going to come down to the numbers for NVIDIA ultimately.
Yeah, it's funny, even amid all the DeepSeek of it all, those big tech giants, those very critical customers to NVIDIA, they're not backing off from their spending plans.
You know what's fascinating, though? It's not that $500 billion number. I think that's the new golden number to use. We're going to bring in now Ryan Lestelica of Bloomberg News to talk more about what to expect from NVIDIA just this afternoon. We were talking this morning about that 10% move expected in either direction here. How high is the bar now that we've seen NVIDIA sell off quite a bit?
I think the bar is probably lower than it's been in other recent quarters, just because we have seen this weakness in the stock. We have had these new concerns about DeepSeek coming out, sort of scrambling the outlook for, what should we expect for AI infrastructure spending over the longer term? What is really going to be the cost of the chip needs to build out this technology? That did sort of, suggest that maybe it won't be as robust as people were previously hoping. So that might create a little bit of a low bar for them to clear this quarter. However, this is really the stock in the market. It has been for almost 2 years now. So I think people, are kind of hoping that we will see that old magic come back. We will see another big blowout, another big, blowout with, beat with the revenue forecast.
Yeah, it's a good point that maybe the bar has been lowered a little bit. You think about recent movement and, of course, the fear-mongering over DeepSeek. And, I mean, we've been speaking to plenty of investors, Nancy Tengler included, saying that she would buy this dip, that, nothing has really changed here. But talk to us about what this means for the broader index. You think about the Magnificent Seven falling into correction territory on an equal weighted basis yesterday, and the sequencing with NVIDIA being weeks after the rest of the Magnificent Seven actually reported. In terms of sentiment, it feels like that bar is still fairly high, Ryan.
Yeah, there's still so much hope that's being pinned on AI. NVIDIA is, of course, the AI stock in the market. It has been for a long time. We did have all those big positive CapEx targets come out from the mega caps, Microsoft, Meta, Alphabet, Amazon. So, the idea that NVIDIA's biggest customers are still spending quite a bit on the chips, on the technology, that does suggest that, there's still certainly demand here. AI is still seen in sort of its early stages, its early innings. So I don't think people are expecting anyone to dramatically pull back. But we did have a report a couple of days ago. Is Microsoft reconsidering its CapEx, how it's allocating? These are all things that are just kind of out there in the ether. And it's going to be obviously critical to hear how NVIDIA is seeing things, how they are seeing their demand for going forward. Obviously a lot to watch out for.
Yeah, absolutely. And just a reminder, Microsoft, nearly 19% of NVIDIA's revenue. Meta platform's not too far behind, accounting for about 10%. Ryan, great setup here. That is Bloomberg's Ryan Vlastelica. And let's continue this conversation with iCapital Chief Investment Strategist Anastasia Amoroso joining us at the desk. Great to see you in person.
Great to see you, Katie.
So let's start with NVIDIA. I tweeted that this is the most important day of our lives, and I was only half joking because
every quarter.
It feels like it's turned into almost a macro event, almost as important as a Fed meeting. And even with these lowered expectations maybe we have going into Jensen Huang after the bell today, I mean, what does this possibly mean when you think about tech leadership and the loss of it?
Right. I think it is a very important event indeed this quarter, and because the setup has been this lack of confidence all of a sudden in technology across the board. And I know some investors have used the excuse of a growth scare and the weaker consumer confidence, but I really don't think that's what it's really about. I think it was about, positions being very long and, you have this renewed fear in the market and that caused those positions to be unwound. So we've seen hedge funds step away from tech. We've seen retail investors really, go in a bit of a buyer strike, even though they've been huge buyers earlier in the year. So what the setup that we have today is we have de-risked the market. We have reduced the positions. The valuations have pulled back. And in some cases, we've also almost cleared the oversold levels, specifically for Mag 7. So that's a much better setup. But what you need at this point is you need a catalyst. And so if NVIDIA ends up being a positive catalyst and there's a beat and raise quarter and there's this, re-underwriting of the positive sentiment on AI, I think that's great positive news for the market.
Let's marinate on the Magnificent Seven. We saw that correction just a day ago. If you look at the component parts, this is what I'm interested in because the dispersion is pretty remarkable. Yeah. You're seeing Tesla, really the dog of the group here, down more than 25%. Oof. Meta is the clear winner here. And my question is, what does all of this say when you look at Apple, Amazon, Microsoft, NVIDIA, all down on the year, Alphabet too? What does that say about investor appetite for believing in these CapEx plans and the desire to see them spend tens, if not hundreds of billions of dollars more?
Right. Well, I think there's the desire if there's a payoff, and I guess that is a big if at this moment. Look, some stocks in particular that you mentioned have struggled because they're continuing to spend on CapEx, but they're not actually seeing the revenue growth. So, Sonali, what I would say is dispersion actually is this story in the market right now. Whether it's within Mag 7, whether it's within the broader market, we see that dispersion among stocks, the winners and losers that we're seeing is actually wider than we have seen for quite some time. And also the correlations, the intra-stock correlations in the markets are falling. And so that actually does create a lot more opportunities for active stock pickers, for hedge funds to pick some of those spots. But what I would say, I do think the CapEx plans for some of those hyperscalers are going to be intact. And to kind of circle back to NVIDIA or some of the software companies or other semiconductors, that's a positive. And what I like about the setup for NVIDIA is they get the last word. They get to tell us, exactly how those CapEx plans are trickling into the NVIDIA business. They get to tell us, I think, that as a result of DeepSeek, the total addressable market for AI and for AI semiconductors have actually expanded. If some of the companies can skip the training phase and go to the inferencing phase, then that means that AI market is not just a hyperscaler market. It means it actually can attract other enterprises or smaller businesses and governments, et cetera, But all of that, those benefits actually accrue to the likes of NVIDIA. By the way, it's not just NVIDIA. We have Broadcom and Marvell reporting next week as well.
Right, good point there, because again, this monofocus on NVIDIA, you don't want to miss the forest for the trees. But let's broaden out and talk about the broader market, because obviously we've seen tech sell off over the past week, but it's really been across the board. When you think about the S&P 500, when you think about the Russell 2000, and I won't ask you if you would buy the NVIDIA dip, but when it comes to the jitters that we've seen in the broader marketplace, is this an entry point, or do you think that there's something to these growth scares that seem to have entered the narrative?
I think it is an entry point, especially when you take stock of just how much repricing we have had. I mentioned that Max 7 is close to oversold, but actually also the median stock in the S&P is down about 13.5%.
Wow.
So we've seen quite a bit of repricing on what I think are growth fears that are actually not justified, which is what leads me to believe that this pullback is likely temporary. The reason why I say the growth fears are not justified, Katie, is because, you look at surveys, you look at soft data, you look at consumer confidence, and that's where you get this negative sentiment. But does it actually mean consumers are spending less? Does it actually mean real-time credit card data is deteriorating? No. Does it actually mean inflation is running at 6%? No. In fact, we get the core PCE number this Friday, which is likely to come out with a print of 2.6%. So that's why I say, given that we're now casting about 2.3% GDP, I think these growth fears are overdone. And I would selectively add to the top ideas in the market now.
If those growth fears are overdone, come in on our favorite topic over the past week, and that's the bond market, because you think about the bid that we've seen, particularly in the long end, a lot of folks have been pointing to those growth fears and saying now's the time to buy duration. If this is overdone, is also the bond market moved too?
It might be. It might be. I think, bond markets really did get spooked from the confidence numbers, from the services numbers, from retail sales. But yes, we do have some hard data come out that sort of refutes what we've seen from soft data. I think we can see those yields come up a little bit. But I don't think they go all the way to the highs that we saw earlier this year. And the reason for that is, take the tax cuts headline from this morning, for example. And there is a concerted effort to try to balance the tax cut with cuts to spending. So that means that it's not going to be just a blanket blowing up of the budget deficit that the markets have feared. So that's why I don't think we go back to the highs.
It feels like a good time to do a lot of market scorecards. We're in the final week of February. A lot of hedge funds are out there cleaning up, window dressing to make sure that this month looks better than it did, which is a pretty tough month. Let's pull up the S&P 500 components for a second here, because the performance of consumer staples, healthcare, real defensive trades at the top of the leaderboard here. How much more room do those stocks have to run? I understand why you would go to staples, for example, but you do see consumer data weakening pretty materially here.
Yeah, I think some of this rotation is likely getting stretched. And, I also say that looking at valuations, and I say that looking at that same relative strength indicator measure. If you look at utilities, consumer staples, they're not actually anywhere close to oversold. In fact, they're close to overbought. So as a contrarian investor, which I think it helps to be in the market, I would rather look to some of the tech stocks that really got hit in the last couple of months and maybe take some of those gains in staples and rotate that back into technology. But there's some sectors, Sonali, from the breakdown that you just showed, like real estate, for example, like utilities. I continue to like those because if the Trump administration is really focused on the 10-year and moving the 10-year yields down and yields down in general, it does benefit things like real estate.
It's interesting. A lot of people, no names here, are looking to refinance a mortgage. I think me and Paul Sweeney among them. iCapital Chief Investment Strategist Anastasia Amoroso. A lot to keep an eye on in the market today. Some more movers on our radar to keep an eye on. Watching Supermicro just surging after it submitted financial reports that will keep it listed on the NASDAQ. Looking at Lowe's as well after Home Depot yesterday, because Lowe's comparable sales turned positive last quarter, partly due to strong holiday activity. And the company is focusing on attracting professional builders rather than do-it-yourself homeowners. GM, interesting story this morning. We're going to talk more about it. Up more than 4.6%. They plan to repurchase $6 billion in shares and raise its dividend. We're going to talk more about that auto industry next. Here, some tariffs are coming there. Let's see how it impacts it all. This is Bloomberg. And now to high interest, a look at what's making headlines around the world. Ukraine has agreed to a draft agreement with the U.S. to create a joint fund that would develop the country's natural resources, including critical minerals, oils, and gas. The deal does not spell out the future of security guarantees for Ukraine, but may help ease tensions with President Trump. Ukraine's President Zelensky said he's still reviewing the final deal, and he will visit Washington on Friday. Big moment. Now, House Republicans passed a budget that was a blueprint to make deep cuts to safety net programs like Medicaid. The budget would pave the way for $4.5 trillion in tax cuts. The measure passed with a 217 to 215 vote along party lines, with only one Republican opposing. The bill now heads to the Senate. And President Trump is opening the door to another metals levy. He signed an executive action directing the Commerce Department to examine possible copper tariffs. Senior administration officials have called the measure necessary to address national security concerns, Katie.
All right, let's turn our focus to autos, because one stock we're keeping an eye on this morning is GM. The automaker announcing plans to buy back $6 billion in shares, also raise its dividend as well. And as you would expect, that news sending shares into the green and then some in the pre-market. Let's break it down now with Bloomberg's global autos editor, Craig Trudell. So, Craig, a big gift to shareholders. Shares up about 4.6% right now. Why now for GM to announce these moves?
Well, I think this is very much in keeping with what Mary Barra has been doing for years now, which, David Welch's story on The Wire does a great job of sort of spelling out just how much buying back she's done the last few years. And it speaks to the idea that, she's really had this company's core business running incredibly well the last, half decade and then some. It hasn't been a matter of necessarily, hitting 1,000. You've had challenges with self-driving bets, and the EV strategy has had sort of bumps over the course of pursuing that transition. But the core business of the company, the big SUVs and trucks that they make their money on, they've been making an awful lot of money on those as everybody's been sort of focused on the next big things. And I think that maybe has been missed. The execution in the sort of old school car business.
I also want to overlay this with the broader challenges for GM and the sector, because you do still see GM shares down pretty significantly this year. But you do also have President Trump on auto tariffs. The quote, I believe, was just let it all happen. And so if you're letting it all happen, then what is the ultimate impact, and how do investors buy into the broader story?
Yeah, I think that's a perfectly good point to make, and looking at this buyback plan, it is pretty open-ended in terms of not having an expiration date, and so we'll see how long it takes for them to get to $6 billion, especially if these tariffs do take effect. But I think we've heard some pretty pitched criticisms of these tariffs from Detroit just in the last couple of weeks. The CEO of Ford Motor Company talking about just how much this would really be destructive even for the U.S. automakers that have quite a bit of production in the country, and that includes Ford, that includes GM. Just because you have an assembly plant in the U.S. doesn't necessarily mean it's entirely reliant on a all U.S. Supply chain. And so tariffs would significantly raise costs for both of these companies, not only for their factories in Canada and Mexico, but even for their U.S. plants.
And so let's talk about the position of these automakers heading into potential tariffs, because while you have GM up 4% and change right now in the pre-market, you have Stellantis lower by 4% or so in the pre-market. Of course, they were out with some news this morning. They expect profitability to remain lackluster. They're trying to revive flagging sales. So they're already dealing with issues ahead of what could be a pretty hefty headwind here, Craig.
Yeah, absolutely. And I think looking at their results out this morning, it's pretty remarkable when you look at the swing in free cash flow from 2023 to 2024. We're talking about almost 19 billion euros. And so this was a company that under Carlos Tavares was sort of consistently hitting its numbers since the merger of Fiat Chrysler and PSA Group. A lot of things sort of under the surface, however, were not going well. I think he really alienated people internally and externally, and the company has really paid the price for that. So we saw efforts in the second half of last year in particular to shut down production, sell through inventory, and there was a sort of there was some success in that, I guess, to the extent you can call it that, in terms of clearing that inventory, but they absolutely paid the price and are being pretty cautious about how quickly they'll be able to recover.
Craig, we thank you so much for all of your time, all of your analysis. That is Craig Trudell of Bloomberg News. And coming up next hour, we're going to talk about Tesla as well. We're going to do that with Pierre Ferragu of New Street Research. Tesla almost erasing all of its gains since the election, but snapping this morning a 4-day losing streak. We'll talk all about it. Stick with us. This is Bloomberg.
All right, welcome back to Open Interest. Let's get a check on these markets with minutes to go until the bells ring. You can see a little bit of a rebound. We're coming off of 4 straight days of losses for the S&P 500. A lot of growth scares out there, a lot of fears that maybe we reached peak AI, but today you can see trying to build a little bit of a rally when it comes to the S&P 500, the Nasdaq 100, where big tech lives, and the small caps as well, higher by about 0.2% though over the past week, completely erasing their year-to-date losses. Let's take a quick look at NVIDIA shares right now, also trying to move higher. You can see NVIDIA shares a little bit higher ahead of the bell, but think about where we stand year-to-date. NVIDIA shares are actually lower on the year, Sonali, for 2025, down almost 6% on a total return basis.
Yeah, and a brutal couple days for NVIDIA. Interesting to see some of that relief before the result itself. I'm looking also at the Philadelphia Semiconductor Index because in the vein of it being the most important day of our lives,
yes,
as you like to say, it could be an important day for other stocks as well. Broadcom is one of the worst performers really in the Philadelphia Semiconductor Index. Marvell not doing that well either, and they both report next week.
Intel out of nowhere, up almost 15%.
The shining star in the sky.
Yeah, we're really in an upside-down world. But coming up, we'll take you through the opening bells. Joining us is Citi's Scott Chronert. Don't go anywhere. This is Bloomberg. Moments away from the start of trading on a make-or-break earnings day. Welcome back to Open Interest. I'm Katie Greifeld. It's the event we've been waiting for, NVIDIA earnings after the bell. What will Jensen Huang say about, of course, Blackwell? What will he say about DeepSeek? And what will he say about the CapEx plans of some of his biggest customers? All of that coming up after the bell. A lot of folks saying that this is as important as the Fed meeting, so we'll have to see. Of course, coming off a big loss for NVIDIA over the past 2 weeks, and it's really been weighing on the indexes. But at least for right now, you see a little bit of a rebound in the futures. You can see the bells ringing over at the New York Stock Exchange, over at the Nasdaq, as well as we officially start trading on this Wednesday. The pre-market moves carrying through as we count through the first few seconds. The S&P 500 higher by about 0.3%. It's a similar story if you take a look at the Nasdaq 100, where big tech lives, higher by about 0.4%. The Russell 2000 also seeing a little bit of love. This has really been where a lot of those growth fears have been expressed in the bond market, but also in those small companies really taking a beating lately. But at least for right now, some green on the screen. Let's take a look under the hood, because today is the first earnings of NVIDIA since the threat of China's DeepSeek sent the stock tumbling in January. We also want to keep a close look on the valuation. It's near the lowest level in a year. It's trading at 28 times estimated earnings, which is pretty much a bargain, Sonali, if you're talking about NVIDIA.
I was just thinking about the bargain hunters. I'm also thinking about your comment on Upside Down World, because over here, it's fun to live in it.
There you go.
I'm looking at Super Micro, up 20% at the market open. It surged after it submitted financial reports that will keep it listed on the NASDAQ. This has been a very volatile stock and suffered some pretty significant one-day losses. Today is a gainer, and the focus now is on the $40 billion sales guidance for the fiscal year. Let's look at some other big tech stocks rebounding after the sell-off. Palantir, Tesla, Broadcom, among the highlights here. Tesla basically flat on the day. I think this is fascinating here. We've been talking about it almost erasing all of its gains since the election. Palantir up almost 2%. Broadcom, I'm interested in the 2% gain this morning, Katie, but I'm more interested in what's going to happen after market after those NVIDIA results for the competitors like Broadcom.
Absolutely. You think about the implications for the rest of the space coming out of the NVIDIA earnings, and there's certainly a lot to keep in mind. But we do want to break you some breaking news right now. This out of the healthcare industry. Eli Lilly planning to spend $27 billion to bolster U.S. drug manufacturing. They're going to add 4 U.S. plants with sites to come online within 5 years. We know that supply has been a big problem for how popular these GLP-1 drugs are, but they've actually been lessening a little bit, those supply shortages, those supply worries, and that might explain why you see the stock moving a little bit lower right now, because $27 billion, that is quite a price tag. We will continue to keep an eye on that story, but let's get back to the news of the day, and that is NVIDIA earnings and tech leadership. Joining us now is Citi U.S. equity strategist Scott Chronert. Pleased to see you in person, Scott. It's been a while.
Great to be here.
So, NVIDIA earnings. Chairman Jensen Huang, what is going to happen tonight when you think about just the state of play heading into the market, the Magnificent Seven in correction territory, and it seems like really tenterhooks when you take a look across indexes?
So when you look at the Mag 7 and NVIDIA in particular, one of the issues that we've been contending with is a beat and raise dynamic. But essentially, if you look at what's happened over the past year, if not 2 years, each time you've seen NVIDIA report, you've had a pretty significant increase to out-year earnings expectations. That's begun to decelerate over the past couple of quarters, okay? That's a little bit of a yellow flag, because what that means is that in terms of what you're pricing in terms of that perpetuity of growth, when it begins to decelerate, it's not great news for the stock price. So what you have to be careful of here is still ongoing, quite strong fundamentals, which I think we're going to hear a lot about. But in terms of the price action, it's going to come down to what happens with those out-year earnings projections. A little bit early to say in that, but that's also now starting to transition into the rest of the Mag 7. Same deal. You're looking at 20% earnings growth collectively for that cohort, but what's been happening is the beat and raise is becoming more of a beat, less of a raise.
Also curious about what happens when you look outside of the big tech world, because we're looking at NVIDIA as it's the most important day of our lives. But the other problem is this growth scare that you're seeing under the market. Is the Magnificent Seven immune from those broader growth scares, and are you afraid of growth right now?
Yeah, so it's a really good question. So we're concerned about growth, but I think that's what you're seeing in terms of the pullback in 10-year yields, okay? So while that might be a headwind for the broader market, it's actually not that bad of news for the Mag 7. Essentially, what happens is that the Mag 7 is probably defensive in terms of conviction in growth, but now as you pull back 10-year yields, I got a little bit of valuation buffer now. And so what ends up happening is we continue to go down this path of, is Trump policy effects going to be net headwind for U.S. economic activity before we get to tailwind? In between there, growth actually does okay as a defensive play, but I do think we need to get through this last earnings point.
From where you sit over, at Citi's equity strategy team, I mean, when it comes to tariffs, the will he, won't he, what sectors are going to be affected, is that an investable theme from your vantage point, or do you need more information at this point?
I don't think it's investable. We've been dealing with this for the better part of 6 months now, and we've kind of come up with, let's call it Trump or tariff trades. But it's all what if.
Yeah.
Lots of what if here. So we've got a whole backlog of what if analysis. But I think ultimately what happens is that trying to dissect each of the Trump components, whether it's tariffs, whether it's tax reform, deregulation, now cost cutting, and isolate those is really difficult. What you have to look at is all of this holistically in terms of what's the implication ultimately going to be for a couple of things, underlying macros, but then underlying fundamentals. Our best guess, all told, is that you're probably looking at a 1 to 2 percentage point headwind to S&P 500 earnings growth. But again, it's still best guess.
And that's from tariffs alone?
That's from tariff. No, that's the whole package.
Okay.
Tariffs, depending on how they get implemented, standalone, we presume 10% across the board tariffs is probably a 6 percentage point hit to earnings. So not good news.
Is the tax cut theme investable now that we have more information on how this is going to be negotiated, particularly where you see spending cuts? You could look at it like a double-edged sword. You're worried about kind of jobs at this point.
So let's come back to this, right? So we're looking at some new news coming out of Congress in terms of where we are with legislation, right? We haven't really kind of dug through the details just yet, but what you're really looking for is a very clear focus on getting those longer-term deficit numbers down. If you can do that, right, that's a real tailwind for bond prices, for that 10-year yield falling lower. But when you see the 10-year yield retreating as it has, likely in response to concern that the aggregate Trump policy is a headwind for growth, short term, maybe intermediate term, that's a different issue, right? So what we're really looking at here is the interplay of these four components. And I think where a lot of the Trump administration focus is you deregulate, you cut taxes, you spur growth, which ultimately expands your tax base and then allows for lower tax rates to become part of the equation of stimulating activity. We're a long way from that.
Right.
We're still in the noise level right now. And so what happens in classic market fashion, we've gotten used to this over the years, is that market tends to sell uncertainty. It tends to buy the alleviation of the uncertainty. We're not to the alleviation point yet. It's probably happening in the next couple of months.
Well, you mentioned, of course, what's going on at the long end of the yield curve, and reasons why matter, but I made the joke to Sonali earlier that somewhere Scott Bessent is smiling. We know that this administration has been super focused on the bond market, specifically on 10-year yields. I want to talk about how you think that this president might care about the stock market, though. There was a really interesting comment on Bloomberg TV from Michael Hartnett from Bank of America yesterday saying that actually Trump will start to look for, or people will start to look for some sort of move from President Donald Trump if the S&P 500 reaches 5,600 to 5,700. And again, I don't think that's an investable theme for you, but does the Trump put, does the Fed put, do those still exist?
I'm not a huge believer in the Trump put per se. What I will say is that in the past month, we put out expectations that 5,700 is a level for the S&P that balances upside, downside, or bull and bear cases. So that's a pretty good starting point. 5,500 is a level that we get really interested in because there you pull the index back into our fair value regime, which right now we're slightly above. So I would say those are two levels that we've written about in the past that I still feel pretty confident kind of represent this. But again, you come back to this Mag 7 influence, Katie, you can't get away from this. It's 30% of the index. I don't know that it's necessarily beating to the Trump policy initiative drum to the degree the rest of the market is, right? So you have to distinguish that from what's happening more broadly.
I want to talk about the wealth effect here as well, because when you have those tax cuts, they have tended to disproportionately help out the wealthier. And when we're looking at the U.S. consumer, you're seeing lower income consumers really take a bite out of very many, actually, company earnings. You've seen some pretty ugly results out there. You've equally seen great results,
right,
but there has been dispersion. So at what point do you look at the bigger picture and start to get worried about the consumer? Are we there yet?
Big question, okay? So the way we're talking about it is that if you look at the past, for the past year or so, we've been saying, hey, you have to keep in mind that the U.S. economy and the S&P 500 has had this positive fiscal impulse at work going back to the pandemic and all of the helicopter money that was being dropped that really spurred consumption. So now you start going down this path of uncertainty regarding Trump policy effects. You throw tariffs in there, and then you begin to talk about cost cutting at the federal government level. All of those potentially come into play with that consumption level. And so what we're very focused on right now is, do we begin to see some deceleration in consumption, which does magnify into S&P 500 earnings at some level, okay? Bit premature, but keep in mind, coming back to Trump and his policy team, what they're really after here is trying to stimulate investment activity. And ultimately, that's a positive read-through to a lot of the consumer and consumption issues that you're talking about. But the path from here to there is an uncertain one, and I think that's what we're starting to feel in the markets right now.
Scott, we thank you so much for joining us here on set. A lot to digest in this market. That is Scott Chronert of Citigroup. We are still looking at more movers on our radar because there's a lot moving under the hood this morning.
It's a busy one.
Busy one. You're watching Stellantis.
Yeah, vaguely, because we were talking about it with Craig Trudell. Of course, Stellantis says that net profit fell 70% last year as sluggish demand in Europe and potential U.S. tariffs weigh on sentiment. And as we were saying, rocky starting point heading into that big headwind potentially.
I feel like you and I have to play Matt Miller when he's not here. So we're going to mention that Lucid is also down more than 7%, almost 8%. They're going to search for a new CEO after Peter Rawlinson stepped aside to serve as an advisor. He was a big personality there.
Yeah, absolutely. And, he stopped by this set before. Hopefully he'll do it again, but not in the CEO role. Workday also having a huge rally.
Evercore analysts saying that the results were what bulls were hoping to see. Let's hope for more bulls entering this market. Given that we've seen quite the sell-off the last couple of days, we're going to bring you more stock coverage next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, we have Redbird and Atlantic upgrading American Airlines to a buy, saying that there's an attractive entry point here. Of course, there's been a lot of news out about airlines recently. But moving along, next up, we have Intuit getting raised to a buy over at Morgan Stanley. That follows the company's second quarter report. The firm sees a 25% upside in shares. You can see well on its way there, currently higher by about 12% or so. And finally, we have Home Depot no longer a sell over HSBC following its fourth quarter report. The analyst is encouraged that the business is strengthening. Shares down a little bit today, though, Sonali, 0.9%.
And we're going to check back in on the stock of the day, NVIDIA, which is leading the Mag 7 stocks higher, finally, after a big correction yesterday. Earnings after the bell are expected to move the stock some 10% in either direction. Let's discuss what this means for the sector and markets at large with Bloomberg Technology co-host Caroline Hyde. You know, we were talking a little bit about the implications not just for NVIDIA, but for the likes of Broadcom and Marvell reporting next week. And what you expect, there has been a swarm of announcements just this week. Some announcements, some speculation around how much might be spent on data centers.
And how much capacity is needed, how much potentially is actually overbought at the moment. I think the theory is, if you look at the hyperscalers and their actual earnings and what they actually announced, they are still spending a lot on AI infrastructure. That is good news for NVIDIA. What I'm anticipating, of course, the market expects that you're still going to see revenues up more than 70%. And in fact, what's so interesting is since DeepSeek sent the real shockwaves, remember they lost $600 billion in terms of market cap on one day alone on the fear that they wouldn't need so many incredibly powerful, incredibly expensive chips. Well, actually, many are thinking that China is going to have ramped up in terms of its own purchases of its H20 chips, those ones specifically less powerful aimed at China. And because of DeepSeek and the furor around building AI over there as well. So we could still see narrative is that this is growth. Is it insane demand that we hear from Jensen Huang? How does he talk about the Blackwell production as well? All of these are still in the know, but really, ultimately, analysts haven't changed their opinion on 2026 growth since DeepSeek. They still see revenue climbing 70% this year, and then, well, more than 100% this year, 70% on the fiscal fourth quarter, and then another 50% next year.
Well, to your point, I mean, you think about their big customers, Microsoft saying that it's still committed to spending all of that CapEx, and then the information reporting yesterday that Meta is in talks to build $200 billion worth of an AI data center campus. Those are its two biggest customers right there. But we were having this conversation a little bit earlier with Ryan Vlastelica that it feels like the bar has been lowered a bit. Certainly in the stock market, you think about the pressure that NVIDIA has come under. I mean, are you hearing that from the analysts and investors you're speaking to, that maybe there's room for surprise?
I think from most investors' perspective, maybe we won't see so much never-ending upbeatness, and we'll start to see a levity come in more broadly as to where maybe some of the guides won't blow past it. We're used to NVIDIA beating and raising. Will we start to see them actually meet? Will we still see, though, perhaps Jensen just try and push back all this pouring of cold water on the never-ending demand for his inference products? He's got to tell people it's not just about training your models, it's about what you do with the model afterwards, and the fact that NVIDIA is still so necessary there. I ultimately still think this is one of the most important moments for macro perspective. We still want to hear whether ultimately the bet on AI. Remember, NVIDIA is trading at 28 times future earnings. That's below its 10-year average. We still think that there's room to run in terms of growth. That would substantiate that sort of a market valuation. $3 trillion company still needs to spell that they're in one-way direction, that is growth and growth in AI. It was about a third of the S&P's gain over the last couple of years.
Right. When you think about how much the bar has been lowered, as you had mentioned, do they have to just meet expectations, or do they need to show something stunning to bring back excitement for the stock this year?
If you go back to the earnings that we saw from the hyperscalers, people didn't care whether you meet or beat on the fiscal quarter. They wanted to hear about the forecasts. And so I think that's where we're going to be focused. I think there's no room for error when it comes to NVIDIA in this moment. We need to see them bring the 73% growth in revenue for the fourth quarter, but we need to hear the forecast still being one of positivity. The fact that we are not seeing any issues with Blackwell demand. There might be some worry about an air pocket forming in between, of course, Hopper and the transition to Blackwell, and the fact that there might be some slowdown in some of the supply chain there and in issues getting it into people's hands and actually use of. Many feel that that's actually been ironed out. So I think for this market, in this moment, we need to hear nothing but positivity from Ms. Jensen-Huang. And
that's true across industries. Scott Chronert just telling us that the look-back numbers have been good, but the guides in this earnings season have been a bit unimpressive. Caroline, you've got a busy show coming up. That is Caroline Hyde. She is Bloomberg Technology co-host. You can catch her at 11 a.m. Eastern. But coming up on our program, Treasuries have rallied mightily this year, despite bets at the start of the year that they would drop. That's next in our Wall Street Beat. This is Bloomberg.
Time now for the Wall Street Beat. Treasury yields hovering near their lowest levels of the year as traders bet on bigger U.S. interest rate cuts and the growth outlook gets gloomier in the United States. Joining us for more, Bloomberg's chief global correspondent for global macro markets, Liz Capo-McCormick. And you look at the expectations changing in Fed funds futures. Curious from your perspective, there's a lot of cross currents in the market right now. What are traders most positioning for?
Yeah, so it's interesting. And like Katie said earlier, the market has definitely rallied mightily in the last weeks. But yeah, I think, some of my colleagues who do some great stuff on positioning, like Ed Bolingbroke, have written about how people are positioning in some hedges and wagers and options and other things for, maybe 10-year yields keep falling further, which seemed like no one was doing that earlier this year, right? Everyone thought, we were going to see more inflation, et cetera. They were going to keep going higher, but they've really turned around. So you do have some positioning turning to kind of wagers on lower yields. Not everybody, of course. There's still those shorts out there, but you're starting to see that pick up. But, there's a lot of cross currents, and, I think there's still a mix of views out there, as always.
Yeah, well, I'm going to ask you a really hard question. I asked this to Mike McKee the other day as well. How does the Fed make policy around the different narratives in the market right now? Because on one hand, you have fears about sticky inflation, of course, tariffs coming down the pike. That would speak to maybe holding rates. But at the same time, you have at the back end growth fears materializing in a big way. I don't know how you thread that needle.
Yeah, now let's see. I didn't hear what Mike said, so I hope I don't get myself in trouble. But I think that's a problem now. But for now, it seems like just by going through the Fed speak, I'm not a Fed whisperer, but they seem to still be saying, hey, kind of we have time to go slow. We're a little bit troubled by inflation, even though they think it's going to come down. They haven't really come out wholeheartedly and saying, hey, we're worried about growth, which they were for a while, right? It seemed like Chairman Powell was worried about the labor market. Now he keeps saying it's holding in pretty solid. But like you said, the market is trading real time off some of this data that's showing some signs of slowing and some concern that maybe what the new administration in Washington is going to do is going to actually hurt growth. So I think we're really watching the Fed rhetoric, and we have the Fed's favorite inflation data on Friday. So if that keeps coming down, then like the folks at Morgan Stanley were saying today, that that might give the market some more mojo for yields to go lower. But if inflation is somehow sticky on Friday, it shouldn't be, because the math kind of lays out from the other inflation figures we've had. But I think, Katie, you're going to see the Fed continuing to say, hey, we're kind of going slow. They really don't want to fail on inflation. But you're right. It's a little bit of a sticky wicket they have to balance. Right. But so far, they're not screaming concern on the economy.
All right, Liz, it's always great to speak to you. That, of course, is Bloomberg's Liz Capo-McCormick. And it's a nice reminder, Sonali, that today is the most important day of our lives until Friday, and that's when inflation takes the stage.
Right. There are many important days ahead. And I do want to point viewers to the story that Liz wrote a little earlier this week, because there's Jay Powell, but then there's also Elon Musk. And it's interesting to see whether the latter will have an impact on the bond market that he might want.
Lots of barrels, lots of snakes, a lot to discuss, and we'll do that in the next hour with Yana Barton from Morgan Stanley, as well as Pierre Ferragu of New Street Research and the CEO of the RealReal. This is Bloomberg. January. We are 30 minutes into the trading day. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is on assignment today. And coming up, it's NVIDIA Day. The chip maker faces its most critical earnings test yet. And taxes and tariffs. The House advances Trump's tax cut plan while the president doubles down on auto tariffs. And retail therapy, much needed. Shares of the RealReal are under pressure. We're going to discuss what's in store for the luxury reseller with CEO Rati Sahi Levesque.
And meanwhile, we get a check on these markets. As I mentioned, 30 minutes into the trading day, we do have some breaking economic news. This is new home sales data for January coming in quite light, 657,000 in terms of new home sales for the month of January. That is well below expectations of 680,000. And it's also well below the prior reading of 698,000. So just to reiterate there, U.S. January new home sales coming in at 657,000. You take a look at the markets right now, though, shrugging it off and then some. The S&P 500 now higher by about 0.6%. Big tech, meanwhile, really rallying into those NVIDIA earnings, which is a choice. The NASDAQ 100 higher by about 0.7%. Of course, we're coming off of 4 straight days of losses, which might explain some of the rebound right now. And the bond market still very well behaved, currently unchanged on the 10-year Treasury yield, but these levels just astonishing. The 10-year Treasury yield at 4.29%, Sonali.
My breath is taken away by 4.3%. And, you know, who cares about home sales in January? You have a 20 basis point move lower since the end of January.
Mortgage rates maybe coming down?
Refinancing, baby. Anyways, joining us now, Yana, Barton, Morgan Stanley Investment Management Portfolio Manager. Would love to talk about the cost of homes, but instead, let's talk about the big day. It is NVIDIA Day, and my question is how much room there is to run in the AI trade, particularly after you've had the sell-off in many of the big names this year.
Great to be with you. Technology is so important for the market. Obviously, it's a third of the total cap. We've got a technology sector driving 25% of earnings. So today's day is very important given the concentration that we have in this sector, but also the growth rate and the profitability that growth rate is coming at. So the growth rate for the sector is over 20%, which is significant because it's twice the level we've seen over the past 10 years. And the profitability of these companies is significantly more than the S&P 500. In fact, the operating income of the sector is twice that of the market, which is pretty significant. So today is an important day, just like every day. I would remind that there are 500 companies in the S&P 500, over 50 trillion of market cap to sift through. But today will be confirmation of AI spend. Obviously, hyperscalers continues to spend a lot of money, and we need to see that demand continues, and there's no wavering in where they're spending.
Well, to your point that every day is important, I mean, Liz McCormick just reminded us that we have inflation on Friday, which of course will take center stage and certainly change narratives around. But talk to us about the sort of the relationship between those dynamics, because you do have growth fears sort of out in front in these markets right now. At the same time, we're grappling with corporate fundamentals when it comes to the earnings front as well. What do you think is the driver of this market, and which are you assigning the most weight to?
That's such a great question. Obviously, the investor sentiment has been bruised for the right reasons. As you mentioned, geopolitical uncertainty, policy uncertainty, growth fears, confirmation of the data points that you just read on the economic front. It's all legitimate. But what I would say is for active investors, this is the perfect time to invest. Why? Because the dispersion of returns that you're seeing, the winners and losers, it's only getting better. And we're actually seeing 2 significant evidence of this data point of what's driving the market. Number one, the co-movement of stocks is at the lowest level we've seen in 7 years, which is great for active investors because the opportunity set is expanding. And the second, which actually answers your question, when you regress the returns of what is driving the stock market and prices today, and you put it in 3 buckets, is it market factors, is it industry sector, or idiosyncratic? For the first time in 25 years, 2/3 of the returns are driven by company-specific factors, which again, as active managers, it's music to our ears.
More music. If you look at the S&P equal weight this year, it's actually up 3%. It's outperforming both the NASDAQ 100 and the S&P 500. My question to you is going to be, if you're so focused, so many investors so focused on the AI story, and you have that bid holding on in the equal weight, then does that suggest that there are gains to be had elsewhere that could be better this year?
Absolutely. And you're seeing that today. 9 out of 11 sectors are outperforming. Equal weighted is outperforming the cap weighted. You have over nearly 70% of companies outperforming the S&P 500. That's, again, evidence and support of the fact that the breadth of the market and leadership is expanding. And there are opportunities. Healthcare being a perfect example of that. Second best performer this year, coming from worst performer last year, still trading at a discount to the market, 20% discount on the multiple basis with better growth. 17% growth versus S&P's 12% growth. Industrials, pockets of consumer, even pockets of tech, software and security in particular. So there are plenty of opportunities if you're willing to do the work.
Well, one sector I do want to talk about, which you highlight in your notes, is healthcare. You take a look at the sector leaderboard year to date. Healthcare, surprisingly, at the top of the pile. That's coming off of a 2024 where the sector as a whole barely managed to squeak out a gain. Even with all the euphoria that we saw and the excitement around GLP-1s, the sector overall really hasn't been doing much. It's in the lead right now, up about 7.4%. Do you think that that's sustainable?
I do. For a couple of reasons. Fundamentals finally turned. The reason why healthcare has struggled actually 4 out of the last 5 years is because of policy concerns, but also fundamentals. We had the COVID sort of, over ordering, and then there were demand issues, and then there were a lot of other issues, obviously being in the political scheme of things. But right now, again, when you look at valuation and the dispersion of industries that you can invest in, it's quite attractive. It's actually the cheapest sector in the market right now on a PE to growth ratio. So if you look, it's trading a little over 17 times, but its growth rate is about 17%. And also the top line growth. So it's not just, sort of the profitability story. There is the top line story of 7%, which is also better than the market. Life science tools, pharmaceutical companies that are still very, very cheap. And also, biotech, which we're waiting for the M&A boom, and hopefully with, the rates coming down, that we can finance a lot more deals. But a lot of opportunities for investors in that space.
We've been talking a lot about Benjamin Graham lately on this show. We've been talking about value investing. Is it coming back? Are people struggling to brush off their playbooks? Because one sector, right behind healthcare, consumer staples, if you pull it up, we were saying how excited could you really get with some of these names? Because they were poor performers last year, weren't they performing poorly for a reason? Is buying something because it's cheap reason enough?
In our Eaton Vance Tax Managed Growth Fund, we take a GARPI approach, which is growth at a reasonable price, and value is in the eye of the beholder. And I would say that investors should focus on the value in the market rather than the style of the investment that they're pursuing. I think consumer staples, while it has done well, and as you pointed out, the best performing sector year to date, there's still challenges that we believe are structural in nature.
Right.
So as investors, we actually want to lean toward secular growth opportunities and somewhere there's sustainability to that growth.
And Yana, we have less than a minute left, but I was playing around with charts yesterday and I found one silver lining to this sell-off, and that is that bonds are actually starting to work. If you take a look at the 21-day correlation between the ag when it comes to bonds and the S&P 500, that negative correlation has come back a little bit. And I'm wondering what that means for you. When you're constructing a portfolio right now, how are you viewing the fixed income market and its place there?
So we don't invest in fixed income, but what you're basically pointing to is asset allocation in different asset classes, and even asset allocation amongst the equity classes is right now good. And as I mentioned earlier, the correlation would prove that to be the case. Correlations across the board are coming down, which means that there is diversity and probability of that diversity actually being a benefit in your portfolio. So that's a good thing. We still think equities is the place to be, though.
There you have it.
Yana, we thank you so much. It's exciting to see diversity come back into the market. And also, Katie, I feel like you're showing off your inner nerd a little bit there with those chart comments.
Oh my gosh, I'm going to have to ask you to put a penny in the swear jar for Matt Miller since you said nerd.
I'm having a little fun without him here, talking about the nerds. Nerds rule, guys. Anyways, Yana Barton of Morgan Stanley Investment Management, we thank you so much for your time. And we're going to talk to next. I'm excited for this conversation.
Yeah, Pierre Ferragu, of course, beating that drum to NVIDIA earnings after the bell. Excited for this one. Don't go anywhere. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. President Donald Trump says he's starting with a new path to U.S. citizenship. The president said that the U.S. will sell gold cards for $5 million to foreigners who create jobs. He said the plan would launch in 2 weeks and that he doesn't think he needs congressional approval. And Chinese President Xi Jinping is calling for calm in response to U.S. aggression on trade. Xi urged his party's top officials to remain composed and signaled a measured response to the Trump administration's new trade and investment restrictions, even as Trump moves to tighten curbs and impose levies. The message from Xi was reported by Chinese state media earlier today. And the information reporting that Meta is in talks to build a new data center campus for its AI projects that could cost more than $200 billion. Shares in Powerlink's companies are trading higher today on the news. Many of these stocks had been sliding this week after a TD Cowen report on Microsoft saying that Microsoft is canceling some U.S. data center leases, and that had earlier sparked a sell-off, Katie.
Well, that's exactly where I want to start with Pierre Ferragu. Of course, he is of New Street Research. He is the head of global technology infrastructure. So there's a lot of consternation about the state of AI spending right now, Pierre, because you think about that Microsoft report, that was from TD Cowen. Microsoft has since come out and said that they're actually spending and still committed to that CapEx number. Now you have Meta out with some pretty big projections for their own AI data center campus. What do you think the mood music and sort of the temperature heading into tonight's report is when it actually comes to AI spend?
Yeah. So if we go first back to this like news flow on data center plans, first thing is to put things into like to try and dimension, the size of each moving part. TD Cowen like broke up like a couple of 100 megawatts of plans that are very long-term plans for data centers that have not even started to build out. And you have to compare that to, 15, 16, maybe 17 gigawatts of data centers that are going to be built just this year. So it's actually a very, very small adjustment part that you have to take into account within the context of OpenAI developing a new partnership, a $500 billion, like a 20 gigawatt type of partnership with Stargate and with mostly with SoftBank. So that moving part is relatively small. And then the other moving part you just mentioned, like the Meta Giga data center plan, we are talking like 5 to 7 gigawatts of build out, so things that are orders of magnitude larger than the adjustments we've heard from TD Cowen. So my conclusion on that is absolutely everybody in the market is still rushing as fast as they can towards deploying 1 million chips, 1 million GPUs or 1 million ASIC chips, working together at training the next generation of models. And yes, you will always have small adjustments. So that's conclusion number one. And conclusion number two is, yes, we are playing with, the veil of ignorance. We don't know what's going to happen with these models we're going to train in 2026, 2027. What is the world going to look like in 2028? So what happens next is always going to be a question mark, and people are going to play with their plans. And so we have to remember that the whole thing is going to remain volatile, even if it's heading very north.
Speaking of the volatility here, we're showing a 5-year chart of the run-up of NVIDIA, but if you look more recently, we're still really in correction territory for the stock. It's down well over 10% from its all-time highs. What do you think this means in terms of the inclination for investors to get in? How high is the bar for the company after market today?
Yeah, I think my interpretation of how the stock moved since, like the DeepSeek crisis, like the Black Monday of DeepSeek, is that first people freaked out, like investors freaked out about this idea that a Chinese player could come up with a model nearly as good and 10 times or 20 times cheaper to run. But then it took 24 hours for investors to understand that's the way AI works. It's always going to be the case. You grow your model 100 times and then you shrink it 10 times, but on a net basis, you've still grown what you do by 10x. So investors got comfortable with that again relatively rapidly. But what that created is actually a repricing of the risk of being exposed to these names. Because investors suddenly realize, okay, things are going to play out fine for NVIDIA this year. We have a lot of visibility, but what's going to happen in 2026? What's going to happen in 2027?
Right.
You could have competition from ASICs. You could have like a pause in spending. And so what we've seen is a repricing of risk. So it has a huge impact on volatility, lots of volatility, and some impact on the multiple as well. And so the stock is getting more and more attractively priced and better reflecting risk. And tonight, we should get good numbers. In order for NVIDIA to beat expectations this year, they need to grow data center revenues in low double digits every quarter sequentially. They've been doing that for 6 quarters. We expect them to continue to do that. The only risk I see on what they print for the quarter, what they guide for the next quarter, is really operations. It becomes a complicated supply chain, and there could be delays in putting together these very complex, liquid-cooled servers, etc. That's the only risk I see for tonight.
Absolutely, and there's 2 parts to tonight's trade. Of course, we have the numbers coming out around 4:20 p.m. expected, and then there's, of course, what Jensen Huang says on the call and in subsequent interviews. Pierre, we don't have a lot of time left, but I do want to talk about Tesla. It's another stock that you cover, and as Sonali and I have been discussing, you take a look at its year-to-date performance, leaves a lot to be desired, down almost 25% or so. Is this a stock that's trading on fundamentals, or are we trading on something else entirely when you consider Elon Musk's ties to this administration?
Stocks are like quantum particles. They are never just one thing. They have like a duality, and Tesla doesn't escape that rule. And so sometimes Tesla trades on fundamentals, on numbers, on the near-term outlook. And sometimes it trades on like the vision, like the concept, the longer-term outlook. So when you look at Tesla today, on the longer-term outlook, things are like incredible. I don't know if you've had a chance to experience what like the full self-driving technology Tesla delivers. It's insane. And so you have this sentiment that Tesla could be very close to really have these robotaxis deployed at scale. And it's a very long-term game. It's even if Tesla delivers like a flawless execution, it's going to take many, many more years to get there. But the size of that price is multiple trillions of dollars, and that is moving the stock. And then right after, behind the corner of this robotaxi revolution, you have the humanoid robots. That becomes the next big thing, and for which Tesla is very clearly on a pole position, capable of bringing to market an extremely cost-efficient, like affordable robot with exceptional capabilities, like humanoid robots. So this is one aspect of Tesla, the dual stock. And the other aspect is that Tesla is a car manufacturer. They're selling cars. They're selling actually premium cars. And premium cars in January is always a very, very tough business. And so like week by week, we track what Tesla is doing, and we see numbers are not good, really, really not good. And the stock is reacting to that. And here the concern for investors is, are the numbers not good because people everywhere on earth are getting upset with Elon Musk? He's so much involved in politics, etc. Or is it just that, the overall demand for cars is not good these days? And this hesitation is bringing the stock back at the moment.
Right, Tesla stock still down almost 25% on the year, still rebounding just a bit this morning. Pierre Ferragu of New Street Research, looking forward to your analysis after those NVIDIA results today. And still ahead for you, this bud is for you. AB InBev sells less beer but makes more money. I'm a Bud Light drinker. Are you, Katie?
I don't like beer. It's like bad soda, I'd rather a gin and tonic.
It's a little bitter, but we're going to bring you details next. This is Bloomberg.
All right, it's time now for Social Climbers, the companies making waves this morning. And first up, no eggflation here. McDonald's is launching a one-day offer so you can buy a McMuffin sandwich for $1. The move is in contrast to restaurant chains such as Waffle House and Denny's that just raised prices on their egg items. Next up, we have Porsche tapping insiders to replace its finance and sales chiefs as it seeks a strategy reset. The car maker is facing waning demand in China, EV apathy in Europe, and of course, President Trump's tariff threats. And finally, bottoms up. Anheuser-Busch is beating earnings estimates thanks to strong sales of Michelob Ultra and Busch Light. The maker of Budweiser has been trying to recover from a slowdown in consumer spending both in the U.S. and in Asia as drinkers avoid bars or trade down to cheaper beer or just avoid alcohol altogether, Sonali.
I also want to bring you some breaking news because Amazon is announcing a rebuilt Alexa assistant with generative AI. You have Amazon executives saying that Amazon has built or is building over 100 Gen AI features. Amazon is investing more in AI than any other company, according to Angie Jassy. The launch event begins in New York, and you have an Amazon executive also saying that Alexa engagement was up 20% last year from 2023. Katie, this was a news day built for Matt Miller. I can already hear him talking to Alexa in the morning next to me.
Yeah, there you go. And you can see that the share is reacting mightily, up about 2.4% right now when it comes to Amazon building on earlier gains. Now, coming up, the RealReal continues to build its buyer base, helping to drive its profits. We'll speak to the company's CEO next. This is Bloomberg. Well, the promise of luxury resale is real and profitable, according to the RealReal, which is the world's largest online marketplace for resale luxury goods. The stock has been on an absolute tear over the past year, but despite beating in its fourth quarter earnings, investors focusing on the company's softer guidance for the full year. Let's discuss it now with Rati Sahi Levesque. She is the company's first employee and its new CEO. Joining us now. Great to have you with us, Rati. And just to set the scene for our viewers who aren't familiar with the RealReal, just explain to us how exactly it works and where you source your items from.
Yes, thanks. Thanks for having us. We're about a 13-year-old company now, almost 14 years. We take in product mostly in luxury, and we play in that mid to high value tier. Most of our items come from people's closets. There's $200 billion in people's closets. $80 billion gets added on top of that every year. The TAM is very large. And we take those items, we partner with the consignors or sellers of these items, and we sell them on our website for the best possible price. It's really what the market will pay for these items. We educate our consignors on what holds their resale value and what maybe doesn't hold their resale value, and again, partner with them to sell their items for that best price.
And so, as you mentioned, I mean, a lot of these items are coming from people's closets. And if that's the case, how can you reliably scale if you're sort of relying, again, on people to come to your site with their items? I'm wondering how you have the confidence that they'll continue to come.
Yeah, it's a great question. We talk a lot about that. We talk a lot about how we procure supply, why it's so important to our ecosystem. Our buyer base is quite resilient. If we have the supply, it sells. And we spend a lot of time thinking about who our consignor is. Again, how do we partner with them? We call that our growth playbook, our supply playbook. That is retail. You see in some of the images, our retail locations. We have, anywhere from 14 to 18 retail locations in the U.S. And there are these neighborhood stores where you can come in and drop off products. So we want to create a real frictionless experience for our consignors so they can come in, drop off in a store. We also have luxury managers out in the field. These luxury managers are awesome. They're core to what we do. They go out. They also build relationships with our consignors. This trust is really important to us. They educate them on what holds their resale value again and what doesn't, and go to people's homes. Again, that $200 billion in people's closet, $80 billion getting added every year. year. TAM is no constraint to our growth, and work with them to procure the supply. So, the sales team, the marketing team, really being able to go after the right consignor in that mid to high value tier that I just talked about, and that retail location creates a frictionless experience for the consignor, so that we can get the supply and continue to bring in those goods.
Rati, my understanding is that roughly a quarter of new consignors last year came from retail stores. Could you double down on the retail strategy you have and how big it could get?
Yeah, we're going to be a digital first company, so I want to say that. But we talk about opening maybe 1 to 3 stores a year. And those stores, not only do they bring in high value consignors for us, so think about coming in to meet with a gemologist or watchmaker. These are, Cartier, Rolex watches. Sometimes you want to talk to a gemologist or watchmaker or meet with a handbag expert and really understand the value of your goods. And that's why we opened these locations. Initially back in the day, you would go into a pawn shop and maybe earn a few cents on the dollar. We have over 40 million luxury shoppers who will pay top dollar for an item. So it created that frictionless experience for the consignor. So not only are you getting new consignors come through, and a lot of what we do is educate people on what consignment means and how they can earn real value. So 50% of our consignors are also new to consignment, not just the RealReal, but new to consignment. They don't think of, reselling their goods when they're buying in the primary market. And that's how we're continuing to change the way people shop every day. So those stores not only bring in, again, the new consignors, but also higher value goods. And then we also see a halo effect happen in that market. So the trifecta of the consignor, that frictionless experience, and our luxury managers being in market really create that halo effect over some of these, key cities for us.
I want to talk a little bit about AI, of course. It's the theme of today with NVIDIA earnings. We just got the breaking news that Amazon has rebuilt its Alexa assistant with generative AI. AI is something that you're exploring as well. You have the Athena AI initiative. Talk to us a little bit about some of its benefits, what you're expecting to do with Athena and what's to come there.
Yeah, it's funny. AI is definitely a buzzword right now, but we are, not new to AI. So we've always focused our investments around data and technology and AI around our moat. And so I think about, our moat as being our data and pricing engine. That's getting smarter and smarter. Again, being able to get the best dollar for our consignors. That's good for our consignors. It's good for us at the RealReal. It's also focused around our sales organization. That's procurement of supply that becomes so important. Our buyer is very resilient in most macro climates. So being able to procure that supply is really important. So giving the sales team and the tools to be able to bring in that supply is another way that we're focused there. And then the last place is what you just mentioned, which is Athena. It's accelerating our inbound process and our expertise. That's the authentication. Most of our items will now be authenticated via AI by the end of the year. Thinking about, gemologists and watchmakers and how that can be a very costly experience, we've focused over the last, 5 to 7 years on automating a lot of that experience. So now we can hire a technician, or our gemologists and watchmakers are looking at the most high-risk items that are coming through. So, thinking that this could be a very costly experience or business to take possession of everything, we got ahead of that really early on in the early years and tried to automate as much as we could.
Rati, from where you're sitting, I want to ask a broader question about the U.S. consumer and the propensity to buy. We're seeing people get really jittery out there. We are not seeing even all luxury behave the same. We're seeing brands fall out of fashion. We are seeing people trading down. What does that look like on your platform?
Yeah, it's interesting. We've been through a few times where the consumer sentiment is a little more careful, another way to put it. But I'd say that our buyer, what we're seeing is that the buyer is quite resilient. And what I mean by that is we're at that intersection of value and luxury, and also offering these one-of-a-kind items. So our average order values have never been higher, actually. When I look at orders that have sold over $5,000, that's actually up 20%. So yes, definitely, a look out, but we're not seeing it in our business this time.
Rati, it's great to get some time with you. Have to leave it there, but hope to speak again soon. That is Rati Sahi Levesque, the CEO of the RealReal. Meanwhile, we're keeping an eye on stocks of health insurers and hospital operators, of course, tumbling on this Wednesday after House Republicans passed a budget blueprint which would include deep cuts in safety net programs such as Medicaid. Specifically, that budget calls for $2 trillion worth of cuts focused on safety net programs such as Medicaid, food stamps, and education funding. You take a look at insurers falling right now, including Molina Healthcare. You're also taking a look at hospital stocks in the Hurt Locker as well, with HCA Healthcare, Tenet Healthcare, and Universal Health Services down pretty mightily as well, Sonali.
We're going to get a look at some other stocks moving as well this hour. We're going to bring in Bloomberg's Jess Menton for that. I know you're looking here at Supermicro, which is fascinating. Not only the best performer, it looks like today on the S&P 500, up now 81% for the year, having its best day since December. How are people feeling about it?
Well, a lot of the focus, of course, has been on those delayed 10K filings for months now that investors were eagerly awaiting. So that deadline was on February 25th. So they came in, and the whole reason for this was they were at risk of being delisted from the NASDAQ. So they had to come through and report that. So they did identify a few internal weaknesses that they pointed to related to AI when it comes to IT type of tech. And then also because of obviously the auditory issues that were coming in after Ernst & Young, obviously their auditor left because of some of the issues there. But moving forward, when you're thinking about Woo Jin Ho from Bloomberg Intelligence, he was actually talking about how now that regulatory overhang that has been weighing on the stock, at least in the short term, is removed, but still it remains to be seen because that company just got added to the S&P 500 under a year, and it's still down over 50% from that all-time high.
It's in all of our 401ks, and even with today's pop, I mean, it's still lower by 37% over the past year. Let's talk about AppLovin, not a stock that I'm super familiar with, but getting some headlines there as well.
It is. So this is a stock that has over $100 billion in market cap. And so when people hear about this is actually a ad company fueled by AI. So it's usually used in gaming, trying to get more users to download different mobile related games here. So what's happening is there were a number of shorts that ended up coming out when you're looking at Fuzzy Panda as well as Culper. And they were questioning.
That's a real name? Fuzzy
Yes,
Panda?
they are. So there's some funny names. And there's also Bear Cave is another one recently that put out a short report for this. So particularly they're questioning its ad practices. And I want to give the caveat because the company hasn't responded to requests for comment just yet for Bloomberg News, and their latest earnings report were better than expected. Of course, it got added to the NASDAQ 100 in November, replacing Dollar Tree, but they're questioning some of its ad practices. Even Fuzzy Panda was questioning whether or not it was stealing particular data that maybe Meta uses when it comes to its ad type platform. But again,
even Fuzzy Panda.
Right, even Fuzzy Panda.
Thank you for saying that with a straight face.
So you have a number of this, but that's why you're seeing that stock pressured. It was halted for volatility, but again, it was up over 500% through yesterday's close over the past year. So it's been a big run here, but you're having a number of short interests that is coming in and questioning its ad practices.
One generation of short sellers pack up their bags, another one moves in.
With silly names.
With sillier names, maybe of the next generation. What about Instacart here? Maple Bear.
Yes.
It's having a tough day.
It is, and so it is publicly traded under Maple Bear, to your point. So the ticker symbol is CART. It's down over 10% on pace for its worst day since November. So when you're looking at this, unfortunately, its earnings disappointed, and it's even tried to turn things around over the past year. It has a partnership with Uber for deliveries at restaurants, and then also it's trying to expand out to non-grocery type of partnerships with Ulta Beauty and things like that. But unfortunately, it just didn't post the same types of results that we would have heard from other delivery type related companies like DoorDash in recent weeks. So the whole question about growth and moving forward, that's why you're seeing that stock pressured today.
Jess, thank you so very much. We are rooting for Instacart because I use it a lot. I'm a very lazy person. You know, Katie, I also want to pull up here the component members of the Magnificent Seven after that correction that we hit yesterday. I want to take a look at what's doing a little better today. Amazon out with that big announcement on kind of amping up their Alexa service here, has it flying back again. Meta, the exuberance is back. NVIDIA posting fairly significant gains ahead of earnings.
Yeah, and a much different picture than the year-to-date leaderboard. If you take a look at the Magnificent Seven year-to-date, one of the big themes, one of the big stories over the past year or so, or at least the past several months, is the dispersion that we're seeing in the Magnificent Seven. This is a group of stocks that used to really trade as a block, and you could kind of reliably count on that. But that has not been the case, certainly not in 2025. And I would imagine that that leaderboard is going to potentially change again after tonight.
Yeah, absolutely. We'll be looking at it again tomorrow. But I've got to say, one thing that fascinated me this morning is you did have Tesla up this morning. You now have it down more than 1.8%. That it's its 5th day of declines. Anyways, coming up, we're going to go into the bromance between not Elon Musk, but instead President Trump, the man in charge, and India's prime minister, because the relationship may be cooling. In today's Wall Street Week, we take a look inside of India's efforts to revitalize its own economy, given the new Trump administration. This is Bloomberg.
All right, it's time now for our Wall Street Week conversation. And both the U.S. and India are vowing to ramp up their cooperation in trade and technology sharing. But even still, the country hasn't been spared from Trump's focus on tariffs and immigration. Bloomberg Wall Street Week host David Weston explores how India is trying to nurture its so-called bromance with the U.S. president as it also tries to revive its flagging economy.
Ruchir Sharma is the chair of Rockefeller Capital Management and author, most recently, of The Rise and Fall of Nations.
Ever since I've been investing in this country for over 3 decades, which is that this is a country that consistently disappoints the optimists and the pessimists. Yet over the long term, it's a very good equity market story in particular, because even after the Indian stock market's big correction over the last few months, the only stock market in the world in the last 30 to 40 years, which has produced comparable returns to America, has been India. So it's this very steady compounding story. But yeah, there are times when people get a bit ahead of themselves, the excitement gets a bit too much. I think we may have reached that point last year when India became the most expensive equity market in the world, literally, even more expensive than America at the top. So that was just telling you that the excitement had gone into a head. And what we have seen in the last few months is a bit of a reset where the optimists are getting a bit disappointed now after sort of thinking that maybe India can break out and grow at 7 to 8%. There's a realism setting in that India's trend growth rate is closer to 6% rather than 7 to 8%. A pretty decent growth rate, and that they still need to carry out some positive reform steps to even keep a 6% type growth rate going. So I think what we're seeing just now is a return to that old reality, so to speak, which has been the case for India for 30 to 40 years, that it's a country which steadily compounds, steadily grows.
But that might not be enough to reach Prime Minister Modi's target of making India a developed nation by 2047.
I think we're reverting to around the 6%. Now, the blip downwards recently has more to do with the fact that we had elections across the board last year, and spending on infrastructure, which has been a big part of the growth story, has sort of faltered over this period. I think that will come back. So we'll get back to 6. Now, the question for India is 6 enough? And unfortunately, the answer is not, because we're also a country that's growing old, and we do want to grow rich before we grow old, and that's unlikely at 6%.
The Indian government has stepped up efforts to re-energize growth, announcing tax cuts in its annual budget in an effort to boost middle-income spending. Raghuram Rajan is a former governor of the Reserve Bank of India and says the big problem for India is a lack of jobs.
We have a lot of young people, and as a result, the dependency ratio, the number of very young people who can't work and very old people who can't work, that's falling.
And that was David Weston on India's economy. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Now, coming up, Hooters is considering a bankruptcy plan that may return the brand to its former parent. We'll bring you the details next. This is Bloomberg.
Now, restaurant chain Hooters is in talks for a potential bankruptcy plan in the coming months. Bloomberg learned that the company's largest franchisee would team up with creditors to control the company. Joining us for more, Bloomberg senior bankruptcy reporter Eliza Ronalds-Hannon. I think the bankruptcy story underneath the surface is pretty fascinating. And when it comes to Hooters, maybe it's not one of the biggest of the past year, but there are some interesting financial details in addition to it being kind of a more iconic American name.
That is a very generous,
is that generous?
Term, yeah.
But the financial complexities are more interesting to me.
Right. What was so interesting to us about it is that we've been really focused in distress reporting on asset-backed finance, and in this case, whole business securitization are the securitized bonds that Hooters has. So those are marketed and advertised as being totally bankruptcy remote. They can never be impaired because they're insulated. They're kind of gated off from the credit risk of the company as a whole. But of course, the question is when the underlying values are going down because of a potential restructuring or bankruptcy, of course, the cash flows that go into the ABS are also affected. So in this case, from what we've heard so far, the plan being contemplated would in fact restructure the whole business securitization, the ABS bonds, as part of the plan. And so that would be a first.
So the financial complexities here are definitely interesting, but I do want to put this into context. The fact that Hooters, is considering bankruptcy here, is going bankrupt. I mean, how does that fit into the context of the overall industry? Because my mind also goes to Red Lobster, which shrimped itself to death. And I'm just wondering, is there a line to draw between those stories, or are we both talking about idiosyncratic cases?
There certainly is a line to draw, because what we're hearing in general is that casual dining is really hurting because the customer is spending so much on daily necessities that they're not necessarily prioritizing a casual night of wings with friends or seafood. The restaurant industry is very much representative of the economy's health as a whole, so that is big.
And we want to pull up the bankruptcy kind of monitor here for Bloomberg. BCY Go on your Bloomberg terminal. In the last year, you could see that, to your point here, Eliza, consumer discretionary really took a brunt of the pain. Now, I want to ask one more question about the broader implications, because what you said earlier about asset-based finance here still coming into some trouble. You have private credit firms saying that this expands private credit to a $40 trillion, $30 trillion, $50 trillion opportunity. Is this a warning sign that perhaps an industry that they considered safer is not indeed that safe?
I think it is a warning sign, and private credit in general and private markets are, of course, really noteworthy for being opaque. And one of the things we've been pointing out in our new private credit newsletter and other newsletters is that you don't know what's going on behind the scenes. You don't know what the asset valuations are unless you're really in the room talking to people who are looking at all of the information behind the scenes and stuff that isn't public information. So a lot of the assets that are supposed to be indestructible, if you peel back the layers, it's vulnerable.
All right, Eliza, great reporting as always. Great to get some time with you. That is Bloomberg's Eliza Ronalds-Hannon. And be sure to sign up for that newsletter, the latest newsletter, all about private markets and the forces moving capital away from the public eye. It's out Wednesdays and Fridays. You can sign up by going to bloomberg.com/newsletters. Meanwhile, a quick check on these markets, of course, all before the all-important event, which is NVIDIA earnings after the bell. The S&P 500 really building on these gains. The NASDAQ 100, your big tech index, really rebounding here, up almost 1%. The bond market, still crickets right now. We'll see if that changes. But coming up tomorrow on Open Interest, we have a packed show for you. We'll be joined by Lisa Shallett of Morgan Stanley, Paul Quincy of JP Morgan, and then we'll be also speaking with the CEOs of Celsius as well as Norwegian Cruises. We'll see you tomorrow. This is Bloomberg.